morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, one of the things I was talking about before the break, again, we understand the problems, right? We understand with regard to what can you do with regard to your retirement. You know, what kind of planning can you do? Do you feel when you hear these things about health care costs, about inflation, about interest rates, when you see what's going on you're concerned about the stock market dropping, interest rates going up again, healthcare costs on the rise. One of the other things was of course, taxes going up as well, right? Because what do we see with the debts and deficits? Sometimes somebody's got to pay that bill, okay? So if we're not collecting enough in taxes now to pay it, either we get a lot more people out there working to help cover it, or we're going to see our taxes go up, and most likely it's going to be a combination of those. And if we think government's going to fix it, again, look at healthcare as an example. This was an Investor's Business Daily. For 2016, all right, the bronze plan under the Affordable Health Care Act, the bronze plan will go up 46% more. The premiums are going to rise by 46%. Remember what I said about my premiums doubling since the passage of the plan, and in fact, about a 50% increase just this year alone, in 2016 that is? Same thing, and that's in Nashville, Tennessee. In different areas, different rates, but in Nashville, right here at home, a 46% increase on the Affordable Health Care Act. Congress, as a part of this of balancing the budget part that they just went through, the budget plan, was that they decided to eliminate a couple of provisions within Social Security filing strategies that we've used in the past, like file and suspend, ways that you can get more out of Social Security for couples. Well, they've taken those out. All right, now they have grandfathered them for people that already have them, so nothing to worry there, and for people well within as far as the cutoff. But this is one of those areas, again, is that helping you? All right, is government solving our problem or making it worse? All right, so it comes down to how do you protect yourself? You really need to understand your investments is one part of that. All right, as I mentioned, the S&P 500 index outperforms 96% of mutual funds, and yet from 2000 through 2009 actually lost money. So let me share something with you. Here's a slide, long-term annualized returns on the S&P 500 versus the average equity fund investor. Remember what I said? The S&P 500 lost money in the first decade, but yet still outperforms 96% of investors out there. So look at the last 15 years, and you can see those green bars. That's the S&P 500 index return, and look at the red bars, what the actual average equity fund investor got as far as a return over the period. And you can see again how poorly the average investor did relative to the annualized returns of the S&P. Now if we look at the next slide, all right, this is showing average. This is another way of showing that bar graph that I just showed you. Now this breaks out different periods. That was a 15-year period. And if we look at if we're looking at now the equity funds on the left of your screen, and you look down, you can see the average return of those equity funds over a given period. So if you look at the most recent period at the very bottom, 5.5% return in 2014, and if you go over to the right under the S&P 500 column, you see 13.69, more than double the return the S&P over those equity mutual funds. If we look at the 3-year period at 14.82, look at the last 10 years, you have 5% on average return for the average equity mutual fund and 7.6, again about a 50% difference on the S&P. That's huge in terms of your returns. Now if you look at fixed income funds, that's the third column in, and you see again those fixed income funds, those are the mutual funds you're investing in. You see those returns in the last 12 months, being in 2014 that is, average return was 1.16% compared to the Barclays Aggregate Bond Index all the way to your right-hand side of the screen at 5.97%. Again, it's huge. In each period, it's the same. The indexes outperform the mutual funds. So you're thinking, well, maybe I should just go into the index. Well, let's take a look at the next screen. All right, the average, if you look at the average U.S. mutual fund, which is that bottom, if you had invested back in 1972, $100,000 invested would have grown to $3 million, okay, over that 40-year period. Now look at the same, if we look at the S&P, the red, at $6 million, almost double the amount of return, and if we look at a more balanced portfolio, even a little bit better than that. But look at that, the S&P 500 actually outperformed the average investor, would have doubled your money over that period. All right, now I'm going to share some things with you. This is the Nobel Prize winning research that goes behind the numbers. All right, so that's just to set the stage for you with regard to the S&P, understanding it and understanding if the S&P outperforms 96% of equity mutual funds, and I just showed you the difference there with the S&P relative to the average equity mutual fund, both in regard to return and in regard to actual dollars, what that would look like. And as I mentioned, over the first 10 years, the $250,000 investment at the beginning of 2000, you would have had less than 250 at the end of 2009 if you would have done as well as the S&P. And I just showed you the S&P did twice as well as the average investor. And at the same time, if we look at the two strategies I'm going to share with you, you would have made almost double that amount over that same period. So think about that. Average investor, okay, makes less than the S&P, and the two strategies I'm going to share with you have done better than the S&P. Something that may help you a lot, right, in terms of return. So we're going to start with understanding the science behind it, because there's science to it. There's research that shows us. So we're going to get into that first strategy. All right, one of the things that we look at, and this goes back to 1990, the Nobel Prize in economics for his equity research was won by Dr. Harry Markowitz. All right, Dr. Markowitz developed what is known as the efficient frontier. And basically what he pointed out was that if you put certain asset categories together, all right, in stocks now, it can be stocks and bonds is one of the examples. So if we look at your portfolio, the balance of stocks to bonds, all right, that they have a negative correlation. When one's up, the other's down, and typically the opposite. Then if you break it down within your stocks, large companies and small companies have a similar impact. So let me show you on this next slide. What this is called is negative correlation, asset class correlation. So if you think about it, if you've got two portfolios, let's say this is a 50-50 stock and bond portfolio as an example, that alone, because of the way they both go up and down at different times, and yet we're looking, if we have both, then we're going to smooth out our returns, thus reducing our volatility, yet still getting the desired rate of return. Now, let's take a look at Harry Markowitz developed what is known as the efficient frontier. So on the next slide, what it's going to show is Dr. Markowitz's efficient frontier, maximizing potential returns for any level of volatility. All right, so now if you look at this chart, on your left, as you go up this graph to your left, it shows the average rate of return on the portfolio. So you can see 6, 8, 10%, 12%, and so on. And then if we go along the bottom, we see 6, 8, 10%, 12%, 14, on out to 20%. That is the standard deviation. That's the volatility or risk in your portfolio. This is over, again, the last 40 years. Now, if we look at the efficient frontier, that's what that line is, okay? So first off, the dot that you see all by itself that's not on the line is the S&P 500 index. Over the last 40 years, it averaged a little over 10%, but that standard deviation, the volatility, the amount of ups and downs, remember those 50% drops in the market? You can see it's way out there. It has a lot of volatility. But now if we go over to the left and we pick the moderate portfolio, all right, the second dot in from the right, and we see it actually gets about the same return as the S&P 500 index, but with about half that risk. In other words, when the market might drop, well, as it did in 08, when the market dropped almost 40%, that portfolio only dropped about half of that, or about 20%. Well, that would be kind of nice if we could get the same return but have half the risk, wouldn't you think? Well, does it really work, though? Dr. Markowitz won the Nobel Prize for this. Well, since then, Dr. Fama, developed what's known as the three-factor model. Now, Dr. Eugene Fama won the Nobel Prize in 2013, just the year before last, for his work in economics on equity research. He built upon the work of Dr. Markowitz and developed the portfolio that I'm going to show you next on the next slide, the balanced growth portfolio. So this is what I was showing you on the efficient frontier, right? That moderate portfolio, 50% stocks, 50% on the fixed side. Well, Dr. Fama developed what's known as the three-factor model. He's since expanded it out to call it now the five-factor model. He's added even different things to make it even better. This is a portfolio then that he would recommend based on his research. This is, in fact, he serves on the board of the company that these funds come from, all right? So this model portfolio goes to what we saw on the efficient frontier. Now, does it work? Well, let's take a look at the next slide and see what the model portfolio would have done over that same 10 years. So we're going to look at the next slide. This is the S&P 500 index on your left. This is a Vanguard fund. It shows the actual returns from 2000 through 2014. All right, a $250,000 investment would have grown to about $450,000 over that period. Now, remember what I said earlier about 2000 through 2009? You can see the 250 investment in 2009 would have been only about $224,000 at that point. Now look across at that balanced growth portfolio over the same period would have been worth over $400,000, $408,000 over that same 10-year period. Which would you rather have, right? Easy answer. And then look, if we looked in the large companies, right, the S&P had a nice run, as I mentioned, from 2009 through 14, and your $250,000 investment now is up to around $450,000, which is just under about a 4% year, somewhere between 3 and 4% per year average return. But look over at that balanced growth portfolio at $550,000, $100,000 more in your pocket, and a return of about 5% per year average. All right? See how important this is? Again, the S&P 500 index outperforms 96% of equity mutual funds like you have in your current portfolio, and the balanced portfolio I just showed you outperformed the S&P, which outperforms probably what you have. So we're going to show you how you can, we're going to call it, that's strategy 1. We got a little more to go with it, and then strategy 2, and a little more to share with you when we come back. All right, strategy 2 I think you're going to like even more. So join us here. We're going to be right back on the Retirement Report.